Hello and welcome. The world of decentralized finance is absolutely packed with opportunity. But let's be honest, when it comes to taxes, it can feel like you're walking through a minefield. That's why the specialists over at ProTax Accountant have put together this discussion to really clear a path and bring some much-needed clarity to the UK's DeFi tax rules.
So you're in DeFi. You're earning returns on your crypto, and you're doing it all without the traditional banks. That's the real power of it, right? But then the hard part kicks in: HMRC's tax rules. It can honestly feel like you're trying to navigate a maze in the dark. So the big question is, how does HMRC actually view and tax all this activity?
Okay, we're going to break this all down with a really clear plan. First up, we'll cover HMRC's fundamental rules. Then we'll get into the specifics of lending, followed by staking and liquidity mining. After that, we'll give you a practical action plan you can actually use. And we'll finish up with the key takeaways. Right, let's dive in.
Now, before we get into all the nitty-gritty of different activities, we've got to start with the basics. How does HMRC even begin to classify this brand new world of finance? You'll see that understanding their core principles is the key to everything else.
So here it is, the most crucial point of all. For tax purposes, HMRC does not see your crypto as money. They see it as property, just like a stock, a share, or even a painting. This one decision, which they lay out in their Crypto Assets Manual, is the reason why DeFi transactions fall under such specific tax rules.
And because crypto is treated as property, two main types of tax come into play. First, you've got capital gains tax. This applies whenever you dispose of your property for a profit. So think selling it, swapping it, or even spending it. Then, on the other hand, you have income tax. That applies when you earn something from your property, like rewards or interest.
Okay, there's a critical concept you absolutely have to get your head around, and it's called beneficial ownership. This is the term HMRC uses to decide if you've actually disposed of an asset. And it all boils down to one simple question: who has ultimate control? If you transfer that control to a DeFi platform, even for a short time, HMRC might decide you've given up beneficial ownership, and that single act can trigger a tax event.
So let's apply this to our first specific example: lending. You might think, well, I'm just lending my crypto out. It's pretty straightforward. But in the eyes of HMRC, that loan can actually be treated as a disposal.
Let's make this real. Meet Priya. She decides to lend one Ethereum, which she originally bought for £1,800 on the Aave platform. Now, at the exact moment she lends it, that ETH is worth £2,500. Because she transferred its beneficial ownership to Aave, HMRC treats this loan as a disposal. Boom! It's a taxable event right there and then.
So let's just do the quick maths. The value at the time of that loan was £2,500. We subtract her original cost of £1,800, and that leaves Priya with a taxable capital gain of £700. Now notice, she hasn't actually sold anything for cash, but she still owes tax. This is what's often called a dry tax charge, and believe me, it's a super common trap in DeFi.
And wait, it doesn't stop there. The loan itself triggers the capital gains tax, but any rewards Priya earns from it, well, that's a completely separate taxable event. Those earnings are treated as miscellaneous income and are subject to income tax. So you're looking at a double-layered tax situation from just a single loan.
Right, as you can probably imagine, things get even more complex when we move into staking and providing liquidity. These activities can create multiple taxable events from a single decision you make.
To make sense of staking, let's follow the story of Tarek. He's a freelancer based in London, and he decides to stake his Ethereum to help secure the network and, of course, earn some rewards.
Just like with Priya's loan, the moment Tariq transfers the beneficial ownership of his 10 ETH to a staking platform, he can trigger a capital gains event. In his case, it's on a £5,000 gain. Then, as he receives his rewards throughout the year, those are treated completely separately and taxed as income. For Tariq, that's another £6,000 of taxable income he's got to report.
And now for liquidity mining, which can be a true tax minefield for someone like, say, Gemma from Manchester. First, when you add your tokens to a liquidity pool, you're often disposing of them in exchange for a totally new asset, the LP token. That can trigger your first capital gains event. Second, any fees or reward tokens you earn are taxed as income as you receive them. And finally, when you decide to exit the pool and swap your LP tokens back, well, you're disposing of the LP token. This can trigger a second capital gains event. It's easily the most complex situation to keep track of. Okay, I know that was a lot of theory. It's complex. We totally get it. So let's shift gears now and focus on the practical steps you actually need to take to manage all of this and, most importantly, stay on the right side of HMRC.
First and foremost, records, records, records. You have to be meticulous. HMRC expects a detailed paper trail for every single transaction you make. We're talking dates, times, values in pounds sterling, wallet addresses, the whole lot. Trying to track this manually is incredibly difficult, which is why using crypto tax software like Coinly or Recap becomes pretty much essential. They can automate most of this for you.
So once you have your records all sorted, reporting it on your self-assessment tax return is a step-by-step process. The deadlines are absolutely key. You've got to register by October 5th if you're new to this, and make sure you file and pay everything by January 31st. You'll report your capital gains and your other income in 2 separate sections of the form.
We have covered a lot of ground, so let's wrap this all up by boiling it down to the most critical takeaways and the next steps you should probably be considering.
The first number to commit to memory is £3,000. For the current tax year, this is your annual capital gains tax-free allowance. Any gains you make from all those DeFi disposals below this amount are completely tax-free. You know, strategically realizing gains under this threshold is a real cornerstone of smart crypto tax planning.
And the second key number is £1,000. This is your trading allowance. It can be used against your miscellaneous income, which means the first grand you earn from staking or lending rewards could potentially be entirely tax-free. Don't forget to claim it.
Now, it's really important to take this seriously. The consequences for getting this wrong are significant. We're talking penalties that can be as high as 100% of the tax you owe plus interest. And make no mistake, with their nudge letters and blockchain analytics, HMRC is actively monitoring this space.
The reality here is that these rules are not simple, and they're probably going to change. HMRC has even consulted on potential updates that could simplify things, but for now, this is the framework we have to work with. And given the high stakes, getting it right is just paramount.
So, our final thought is this. Don't try to navigate this maze on your own. Getting professional advice can save you a ton of time, a lot of stress, and potentially a lot of money. If you need a guide to get your DeFi taxes right, reach out to the specialists at ProTax Accountant. They live and breathe this stuff every day, and they can help you stay compliant and feel confident in this new world of decentralized finance.